The biggest question in personal finance is where do you put your money to get the best return? Today we're going to dive into four popular investment options: a traditional bank savings account, a high yield savings account, the stock market, and real estate. And for each one of these, we're starting with the initial investment of $100,000, leaving it alone for the next 10 years, meaning no adding extra cash throughout the years, just letting it sit. Hey, I'm Hamza Riyasat, a realtor here in North Georgia, and along with my younger brother, we help people buy, sell, and invest in real estate. So without further delay, let's explore which investment option make your money work the hardest for you. And along the way, we compare each investment option against the average inflation rate over the past 30 years, which has been 2.5%. This will show if each investment keeps up with the inflation and builds real wealth on top of it. Let's start with the simplest option, a traditional bank savings account. Most of us have it. Matter of fact, 57% of the Americans keep their savings here. With this option, you have no responsibilities, no management, and it's risk-free since it's FDIC insured. But here's the catch. A traditional saving account typically give you around 0.4% per year. So if you put your $100,000 here and leave it alone for the next 10 years, it will barely grow to $104,000. In comparison to the inflation at 2.5%, this means you're actually losing money. Because in 10 years, you'll need above $128,000 to be deemed profitable due to inflation. Next, let's look at high yield saving account. This is a step up and becoming more popular option for savings. Around 18% of the Americans keep their money in high yield savings account. Just like traditional savings account, you have no responsibilities, no risk. It's an attractive option if you want to keep things simple. With an average return of 4.5%, your $100,000 will grow to about $155,000 in 10 years. It's definitely a better alternative to a traditional bank savings account. And this time, it stays slightly ahead of inflation. Now, let's move to stock market. This is where we start seeing real growth potential. About 61% of the Americans own stock, which can provide higher returns, but with certain levels of risk and responsibilities. One thing to note, there's little day-to-day responsibilities, but you might experience emotional ups and downs as the market fluctuates. So if you invest $100,000 and don't touch it for the next 10 years, assuming the 10% annual return, you see it grow to about $260,000. That's a significant growth, easily beating inflation, and showing why stocks remains the popular choice for building wealth. Finally, let's look at real estate, an investment option I know well as a realtor. Unlike stock and other investment options, real estate have multiple wealth streams. You have appreciation, your property value increases, depreciation, the money you save through taxes, cash flow, your monthly rent profit, and mortgage payoff. But it comes with high responsibilities unless you hire a property management team. And with only 7% of Americans owning rental property, real estate requires certain levels of commitment and responsibilities. Let's break down the numbers. With a $100,000 initial investment, you can buy a $500,000 property minimum with a 20% down payment. Real estate has been appreciating at 4.5% over the past 30 years. This is including the 2008 recession. Now, the main thing to note is you're getting that 4.5% appreciation on $500,000, not $100,000, which translates to 22.1% returns on your initial investment of $100,000. So with appreciation alone, you're making $276,000. And there's also depreciation. The main thing to note over here is you can only depreciate the property value, not the land value. So let's say the land is $100,000. So subtract $100,000 from $500,000, leaving you with $400,000. So you're getting a depreciation of 3.6% on $400,000, which translates to 14.4% on your initial investment of $100,000. Adding up to $145,000 in 10 years. Now, let's talk about cash flow. To be conservative, I'm going to downplay cash flow a lot. So let's say you're making $100 profit on cash flow for the next 10 years, which is the minimum you should be making to accommodate for the occasional vacancies or any big repairs, which totals to $12,000 over the 10 years or 1.2% annually on your initial investment of $100,000. And finally, mortgage payoff. Over the 10 years, you pay off about $59,000 on the principal. This equity builds with every payment you make, adding value to your investment. So adding everything up, we have the initial investment of $100,000 $100,000, the appreciation of $276,000, the depreciation of $145,000, the cash flow of $12,000, and the mortgage payoff of $59,000, which equals to $592,836. Now, just to put it in perspective, this is 121 times the traditional bank savings account, 9 times the high yield saving account, and 3 times the stock market. So which option is the best? If you're someone who don't want any risk or responsibilities, then high yield saving account is the best option. You may not make the most profit though. And if you're someone who just wants to maximize your returns and don't care about responsibilities or risk, then real estate is the best option. Thanks for joining me on this breakdown. I hope this helped you understand where your money works the hardest for you. If you need help investing in real estate, let's schedule a meeting today.